15.5%. That's the annual free cash flow growth rate the market is demanding from NVIDIA right now, compounded, year after year, for a full decade. Not just a short burst, not a one-off spike, but a relentless sustained climb. And here's what makes it even more striking. That 15.5% hurdle is over 40 percentage points lower than the company's most recent annual free cash flow growth, which clocked in at a staggering 58.9%. The market is asking for a lot less than what NVIDIA just delivered, but it's still asking for a whole lot, especially at this scale. Stick with me because by the end of this video, you'll know exactly what the market price is really saying about NVIDIA's future. You'll see how a single shift in the discount rate can dramatically change the growth that's needed to justify today's price. And there's a twist in the model's sensitivity that most investors miss, one that can make all the difference for anyone trying to understand what's truly priced in. Let's start by grounding ourselves in what NVIDIA actually does. You hear the name everywhere, but what's at the core? NVIDIA designs accelerated computing platforms. That means they're in the business of creating the hardware and systems that power some of the world's most demanding applications. Think graphics processing units, GPUs, that drive everything from high-end gaming to scientific simulations. And think AI infrastructure, the backbone for artificial intelligence workloads, training, and inference. In short, NVIDIA is at the intersection of computing power and the next wave of technology. That's the context for the numbers we're about to break down. Now, let's get specific about the snapshot. As of July 17, 2026, NVIDIA's shares are trading at $207.40 each. The total market capitalization, the combined value of every share outstanding, is a jaw-dropping $5,023,435,063,296. Every number in this analysis is in US dollars, so you don't have to worry about currency conversions or shifting exchange rates muddying the picture. And when we talk about free cash flow, we're looking at the trailing 4 quarters, from July 31st, 2025 through April 30th, 2026. That's a rolling window, not a calendar year, and it captures the most recent business performance. For that period, NVIDIA generated $119,076 million in free cash flow. That's the money left after paying all operating expenses and capital investments, the cash that could in theory be returned to shareholders or reinvested for future growth. But here's the question. How do you connect that $119 billion in trailing free cash flow to a $5 trillion market cap? That's where reverse discounted cash flow, or reverse DCF, comes into play. Most of the time, investors use DCF to estimate what a company is worth by projecting future cash flows and discounting them back to today. But reverse DCF flips the process. It starts with the current market price and works backward, asking, what kind of future growth must the company deliver to justify this price given a certain discount rate and terminal growth assumption? In this case, the model uses a 9% discount rate. That's the annual return investors expect to compensate for risk and the time value of money. The model also assumes that after 10 years, NVIDIA's free cash flow will grow at 2.5% per year into perpetuity, a standard, conservative terminal growth rate. So with those assumptions plugged in, what does the reverse DCF tell us? The answer: to justify today's price, NVIDIA's free cash flow must grow at 15.5% per year, compounded, for the next 10 years. This isn't a forecast or a recommendation, it's simply the growth rate embedded in the current share price, given the discount rate and terminal growth. And this is where the historical numbers become crucial. Let's look at the trajectory. In 2023, NVIDIA's annual free cash flow was just $3.8 billion. By 2024, it had soared to $27 billion. In 2025, it reached $60.85 billion, and by 2026, it was $96.68 billion. The most recent year-over-year jump from 2025 to 2026 was a blistering 58.9%. But the reverse DCF isn't asking NVIDIA to repeat that kind of explosive growth every year. Instead, it's looking for a compounded annual growth rate, CAGR, of 15.5% over the next decade. That's a much smoother, steadier climb, but it's still a huge ask, especially starting from such a high base. But let's not get ahead of ourselves. The implied growth rate of 15.5% is just one piece of the puzzle. The real intrigue comes when you look at how sensitive this requirement is to changes in the discount rate. The model gives us three scenarios. At an 8% discount rate, meaning investors are willing to accept a slightly lower return for taking on risk, the implied annual free cash flow growth drops to 13%. At a 10% discount rate, if investors get more cautious and demand a higher return, the implied growth rate jumps to 17.9%. This isn't just a technicality, it's a reminder that what the market is pricing in is not static. If the macro environment changes, if inflation expectations shift, or if the appetite for risk goes up or down, the discount rate moves, and so does the growth hurdle. Even a single percentage point change in the discount rate can swing the required free cash flow growth by nearly 5 percentage points. That's a massive difference when you're dealing with numbers in the tens of billions. So what does it really mean for NVIDIA to deliver on this implied growth? Let's dig into the what must go right scenario. To meet a 15.5% compounded annual free cash flow growth rate for a full decade, NVIDIA would need to keep expanding its cash-generating power at a pace that's rare for any company, let alone one already producing nearly $100 billion in annual free cash flow. That means not just maintaining, but growing its leadership in accelerated computing and GPUs. It means staying ahead of competitors, continuing to innovate at the cutting edge of AI infrastructure, and finding new markets or applications for its technology. The company would need to execute flawlessly on both the technical and business fronts, scaling up operations, managing costs, and reinvesting wisely to drive continuous growth. But there's more. The implied 15.5% growth rate is a full 43.3 percentage points lower than the most recent year's 58.9% growth. That sounds like a big cushion, but it's important to remember that the latest year was extraordinary, a period of explosive growth that's unlikely to be repeated indefinitely. The reverse DCF is not asking for a repeat of that performance, but it is asking for a decade of robust, compounding growth from a much higher starting point. The bar is lower than the recent past, but it's still high, and the scale of the numbers involved makes it even more challenging. So what could go wrong? This is where the risks come into focus. The reverse DCF model is built on assumptions about growth, about the discount rate, about the terminal value. If any of these assumptions don't hold, the math changes quickly. For example, if NVIDIA's free cash flow growth slows to say 10% per year instead of 15.5%, the current share price can't be justified under the same discount rate. If the competitive landscape shifts and NVIDIA loses ground in GPUs or AI infrastructure, future cash flows could fall short. If the cost of capital rises, meaning investors demand a higher discount rate, the required growth rate moves even higher, making the hurdle even tougher to clear. And if the company faces unexpected challenges, regulatory changes, supply chain disruptions, or market saturation, the compounding effect over 10 years can have a dramatic impact on the valuation. It's also worth noting that the reverse DCF doesn't account for volatility or uncertainty in future cash flows. It assumes a smooth, compounded growth rate, but real-world results are rarely that tidy. Cash flow can be lumpy, driven by product cycles, macroeconomic factors, or shifts in demand. If there's a single year of underperformance, it can throw off the entire compounding trajectory. And because the model is so sensitive to both growth rates and discount rates, even small deviations from the implied path can make the current valuation look aggressive. So where does all this leave us? The reverse DCF snapshot gives us a clear lens. At a 9% discount rate, the market is implying that NVIDIA will grow its free cash flow at 15.5% per year compounded for the next decade. That's a steep climb, but it's much lower than the most recent year's explosive growth. The model's forgiving verdict reflects the gap between the implied rate and the latest result, but it doesn't mean the bar is low. The challenge is real, and the stakes are enormous. The key limitation here is that the reverse DCF doesn't predict the future. It simply tells you what the market price implies, given the assumptions you feed in. Change the discount rate, and the required growth shifts. Miss the growth target, and the valuation story changes. The model is a framework, not a crystal ball. So what's the bottom line? This isn't investment advice, and it's not a prediction. It's a way to see what the market is really expecting from NVIDIA, and how much has to go right for those expectations to be met. The numbers are clear, the margin for error is slim, and the stakes, they couldn't be higher. When you look at NVIDIA's price, you're not just betting on technology, you're betting on a decade of relentless compounding growth at a scale few companies have ever achieved. The market has set the bar. Now it's up to NVIDIA and time to see if it can clear it.